This is Jim Bell, the founder and chief investment officer at Bell Investment Advisors. Welcome to our webinar today. This is our investment committee update for second quarter of this year. And the title is this as good as it's going to get? I'm joined today by Corinne Salera Bedford, certified financial planner, lead analyst on our investment committee, portfolio manager, investment advisor. Thank you for doing this with me today, Corinne.
Of course, happy to be here. Thank you, Jim.
If you're having any technical problems, you can call our office at that 800 number, 800-700-0089. We hope we'll try to help you out. And also, you have a question box on your screen, and we encourage you to submit questions or comments. We'll try to answer them live, but if we're not able to do that, we'll make sure that we get back to you with some answers. So let's go ahead and get started. This is our overview of what we're going to cover today. I think of this topic as describing the tug of war that's occurring right now between negative and positive forces in regard to the performance of the stock and bond markets, for that matter. So in that category of negative and positive forces, we have the trade wars and tariffs, midterm elections, a labor shortage, economic strength and interest rates, tax cuts for consumers and business, and solid corporate earnings growth. So we got the idea from this title from the earnings call from Caterpillar for Q1 in terms of is this as good as it's going to get? And Corinne's going to take us through what we learned from Caterpillar.
Yes, thanks, Jim. So as he mentioned, our title was inspired by Caterpillar's first quarter earnings call from this year. They are the largest maker of construction and mining equipment, and the machinery giant is closely watched as a harbinger of global economic health. In listening to the call, really the tone and outlook overall was very positive. They lifted 2018 profit projection by 24%. But what made headlines was a comment by the CFO signaling first quarter might be as good as it gets. What he specifically said was that Q1 2018 profit will be, quote, the high watermark for the year. And what he mentioned, or what was mentioned on the call, was that they foresaw expected increases in capital investment later in the year. No mention of increased costs, though other companies have specifically cited tariffs and increased costs as a concern. In fact, a recent CNBC Global CFO Council survey showed that 2/3 of US companies say the Trump administration's tariffs will have a negative impact on their companies. So Jim's going to talk a bit more about that.
Thanks, Corinne. So we'll start right there in terms of the trade wars and tariffs. This is definitely a negative influence on the status of the stock market, including a drop that we had today. This is Wednesday, June 27th. So just some background. A tariff is a border tax imposed by a country on imported goods. Tariffs are the weapons of trade wars. Basically goes like this: you tax my products and I tax yours. And that's what we're seeing right now as Trump has proclaimed tariffs and implemented some. Our trading partners are retaliating, and this is not good for business or the market. It creates a lot of uncertainty and financial hardship. It's a real headwind. Tariffs increase costs for U.S. consumers. Tariffs are taxes on families. tariffs kill more jobs than they create, and for every job saved by the steel and aluminum tariffs, 5 jobs are lost. And the source for that was the March 6th edition of the Wall Street Journal. So that was our sort of run through on the tariff issue. Next is trade deficits, and trade deficits and tariffs are kind of a 1-2 punch, the way that current administration is using them. Trade deficits occur when countries import more from other countries than they export. The vast majority of economists agree that really the statistics about trade deficits or trade imbalances is basically useless information. It's not a bad thing, a trade deficit. And the most common cause of a trade deficit is when Americans buy foreign goods at a lower price than the same goods made in the USA. So the way I think about trade deficit that we have here in the United States is it just meant that our business and consumers, they got a good deal. They were able to buy goods and services at a low price with the quality that they wanted. You can see on this circle chart here that China is the biggest source of our trade deficit. The overall U.S. trade deficit is about $568 billion. Almost 60% of that comes from China. The other 3 countries that we think of as allies, Mexico, Germany, and Japan, are also being hurt by Trump's kind of universal blunt instrument, the way he throws around tariffs and his talk of trade deficits. Economist Megan Green writes that rich economies with deficits have grown faster than surplus economies over the past decade. So this is a good example of how a trade deficit is not a negative thing. And this statement bears that out. 42% of the clothing and 72% of the footwear bought in the United States are imported from China. It's pretty amazing statistics. And if we look at the past 2 decades, a shopping cart of clothes purchased in the US today costs less than it did 20 years ago. So American consumers have saved billions of dollars because we're getting a good deal from China. They are very good at assembling things, making clothes. We're very good at making airplanes, and it's a good trade-off. It's not a negative thing. Next, we'll go to the effect of the midterm elections. This comment from Schwab and Company talks about midterm election years have historically been accompanied by larger market swings and greater maximum drawdowns, and we've certainly seen an increase in volatility today for a number of reasons. The trade and tariff threats and implementations have certainly been a big issue. The midterms coming up in November create a certain amount of uncertainty that the market doesn't like. And we believe that after the midterms are over and the results are known, taking away the uncertainty, that will be a help to the stock market as long as there aren't other more oppressive activities occurring. The next topic is a labor shortage. This is a situation where it's counterproductive that we have such an anti-immigration move by the administration at this point. There are more jobs open in the United States than there are jobless workers. So it's not that we need more jobs, we need more workers. And immigration policy historically has been an excellent way to solve that problem. There's 1.2 million agricultural workers in the US that are estimated to be undocumented, if we get rid of all those people, the agricultural sector is certainly going to suffer and our U.S. economy will suffer. So I'm going to turn it back over to Corinne, who's going to talk about jobs, jobs, jobs.
Yep. On to the positive side of the coin for jobs and some other tailwinds we see to the economy and stock market. So we have seen the longest record of job growth ever at 92 months, with a very, very low unemployment rate sitting at 3.8%, which is the lowest we've seen since 2000. Some other data points we think are relevant is that non-farm payrolls grew by 223,000 in May. And the stat that resonates, I believe, the most with me at least, is that the participation rate is quite strong among prime age workers. Those are workers ages 25 to 54. And that rate is currently 81.8%. And that's higher than it ever was before 1986. Other strong fundamentals we want to touch on are certainly the tax cuts, not only the tax cuts, but deregulation and the repatriation of foreign profits. Those were certainly a massive stimulus package for the US economy and stock market. Q1 2018 was the first chance we got to see the corporate tax cuts in action, and the results were very strong. So for Q1 2018, the largest 500 companies in the US, based on the S&P 500, they grew at a rate of 24% year over year. And that's the highest earnings growth rate we've seen since 2010. Just one comment, the earnings results outside of the US, specifically Europe and Japan, have been somewhat weaker. So that's something that I'll talk about a little bit more later on, but I did want to mention it. So honing in on the estimated tax impact on US earnings, Northern Trust estimates that corporate tax reform added 8 to 9% to reported earnings growth in Q1 2018. You can see this visually represented by the green shaded portion of each bar. We have core EPS, or earnings per share growth. That's the solid green area of the bar. And then stacked on top of that is the tax impact to earnings growth per share. And you can see here that there's a similar expectation for how taxes, or lower taxes rather, will impact earnings for the rest of the year. It will continue to have a strong impact, at least within the US. So whether it's the competitive tax landscape or something else, businesses are very confident. You can see this based on the NFIB Small Business Optimism Index. And consumers are also confident. You can see here, based on the Consumer Confidence Index on your screen. So that's great to see that the sentiment appears to be quite strong, whether we're looking at it from a consumer standpoint or business, but we're also seeing it carry through to the hard data. So just a few examples here. US companies are investing in their businesses at the fastest pace seen in years, up 24% from a year ago. US banks just logged a record high quarterly profit. And as I mentioned, consumers, they appear to be confident, and they also appear to be spending. So as an example, Macy's same-store sales were up 3.9% in first quarter 2018 from a year ago. So what does that all mean for gross domestic product? Well, we think it's very positive. The Atlanta Fed estimates that second quarter GDP growth will be 4.7%, which is certainly a high point than what we've seen in years. So on to fixed income and bonds. So the Federal Reserve is responding to the sound economic data and the reasonable inflationary environment by normalizing monetary policy. So just 2 weeks ago, the Fed raised rates based on the Fed funds target rate, another 0.25% to 1.75 to 2%. That's the range. So that was the second rate increase this year, with 2 more predicted for the remainder of the year. Just as a reminder, the federal funds target rate, that's the interest rate at which depository institutions lend reserve balances to other depository institutions, essentially banks lending to each other. So the question, of course, that we want to answer and that many clients are asking us is, what does this mean for bonds with the federal funds target rate increasing? So what we're telling our clients, and what we want to reiterate here today, is that it doesn't necessarily mean losses for bond investments. We've shown this slide before, but felt it was worthwhile to revisit. So this shows the last 7 periods of federal funds rate increases, or those rate hike cycles. So if you look at the bottom of the screen, the gray circles represent the amount that the federal funds rate increased during each selective period. And above that, you see the corresponding returns of intermediate term bonds during that time period. So what I want to draw your attention to is, yes, there were 2 periods where bonds lost money. So that was in the 1987 cycle, and then again 94 to 95. But the losses were not dramatic. And in the other 5 periods, the results or the performance was positive for bonds. So we do not feel that this is a time to abandon the asset class. I mentioned earlier on that earnings in other regions do not appear to be as strong as the US. And there are other indicators that there's softening happening internationally, and that momentum is shifting to the US. So what you see on your screen here is the composite PMI index. So the PMI looks at things like new orders, employment levels, inventories, etc. And we have seen a decline from year-end 2017 to May 2018. Those are the 2 different bars that you see on this bar graph. A reading above 50, which all of them are, generally is a sign of expansion in the region. So it's still a positive outlook, but again, you can see that in the areas outside of the US, we are seeing some softening or weaker numbers as we move into 2018. We do feel that there's a great long-term outlook in international investments due to better valuations, and that those economies are earlier on in their economic cycles. But in the short term, we do feel there are more headwinds for international investments given a rocky geopolitical environment, and again, to reiterate, fundamentals that are not as strong as the US. So now I'm going to turn it back over to Jim to share some of our conclusions.
Thanks, Corinne. So as we've demonstrated here, volatility this year is much higher than it was last year. 2017 was an extraordinarily calm year. We're not experiencing that this year, and with all the forces that are battling it out, it's like the equity markets are likely to continue with a higher degree of volatility. Our point about bonds is that they do get a boost from stock market volatility, as Corinne mentioned. Even though we are in a rising rate environment, they still have a role to play. The bond market had a good day today as the 10-year Treasury yield dipped below 2.9%. As you may know, it's been as high as 3%. So the diversity and stability and that bonds offer are still valid in appropriate portfolios. The stock market fundamentals certainly support a higher high in our view. And if it were not for the controversy about trade war trade wars and tariffs, we believe the market would be much higher than it is now, as the earnings growth data certainly supports that, among other factors. I just saw a headline on the internet just this afternoon, actually, and it was a question, where has the businessman Donald Trump gone? Some of the things he's saying, especially the way that he's attacking Harley Davidson now, reflects a lack of understanding or sensitivity to how business leaders need to operate. Here he's angry at Harley Davidson for having overseas operations, and the leadership at Harley, they're just doing their job. They have an obligation to shareholders, and it's hypocritical of Trump, whose neckties are made in China, and his daughter's clothing line is mainly made in China and other parts of Asia. So what's good for the goose should be good for the gander, but that's not what we're seeing. So this creates a lot of turmoil and uncertainty, and is a barrier to business development. On the positive side, it's clear we've seen some evidence that President Trump does back down from some of his more extreme counterproductive decisions. You may have seen that he announced that we were going to severely limit and cut off investments from China in our technology businesses. It was kind of a blunt instrument, again, across the board, and there was a softening on that announced last night or today that in fact it wasn't going to be so blunt or universal. These proposals for Chinese investment in our businesses was going to be run through the CFIUS committee, which is a group that analyzes potential national security threats, and they can cut off investment. So it went from a very blunt blanket statement to a softening that now includes a process. And the market originally responded positively to that, but we did not end up on a positive note in today's market. So this resolution of what's going on with the trade war is really crucial. That's what's in the way right now. It's the only thing we believe that's standing in the way of growth in the U.S. stock market. So that's what we wanted to share with you today. Please submit your questions now. We'll make sure to answer them. We always appreciate you staying in touch with us. We always welcome your calls and queries. This webinar has been recorded, and we will post it on our website in our webinar library. That should be complete next week. You can see on the list here that we have a number of information and webinars in the inventory in our library that you're welcome to take a look at. There's a number of ways to stay in touch with us through our blogs and so forth, so we hope you'll take advantage of that. And I also want to let you know that if you would like a copy of today's presentation slides, we can send that out to you. There will not be a delay on that. So thank you for joining us. We will be doing our next investment committee update for the third quarter in September. We haven't scheduled that yet, but that will be coming, and we'll be sure to let you know about that. Mm-hmm. So Corinne, thanks again for working on this with me.
Of course, thank you.
And everyone, have a happy summer.